Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Tech earnings previews, CapEx analysis, and trade executions.
This video presents a direct informational narration of the source document.
Section 1. Market Review and Investor Mindset. During the recent World Cup, cameras caught a blurry Lionel Messi walking down the tunnel after a really tough game. It's a great reminder that even the absolute greats aren't perfect. Well, in investing, demanding perfection, trying to nail the absolute bottom or exact top on every single trade is just as impossible. You simply have to accept some misses to achieve long-term success. We really saw this reality check in last week's market action, didn't we? Monday started off incredibly strong with cooling inflation data, solid bank earnings, and some really encouraging retail sales. But by Friday, we saw a total liquidity drain. Market makers who were heavily hedging their options, what we call positive gamma positions, basically meaning they were buying and selling rapidly just to keep their risk neutral, unleashed a massive wave of volatility in the afternoon as expirations cleared. And that structural weakness carried right over into today's session. We got a low-volume gap down across the indices, with a staggering 337 S&P 500 components declining and only 165 advancing.
Section 2. Middle East Impact Muted.
We've also been tracking some severe geopolitical escalations recently. Just look at this timeline. We had 9 consecutive nights of airstrikes between the US and Iran, a tragic attack in Jordan resulting in the deaths of 2 US soldiers, and subsequent US strikes on an Iranian nuclear facility. On top of all that, Houthi forces have announced a blockade on Saudi-linked ships, pushing international oil prices all the way back up near the $90 mark. Yet, despite these major developments, the situation basically remains locked in a tense stalemate.
So you might be wondering, why is the broader market barely reacting to any of this? Well, the answer comes down to extreme capital concentration. Right now, the vast majority of active institutional and retail money is completely hyper-focused on artificial intelligence and semiconductors. Because everyone is so crowded into those specific tech trades, major global disruptions in the energy sector and even inflation-related trades are essentially being ignored for the time being.
Section 3. The Tech CapEx Seesaw. This brings us to the core dynamic driving the market right now, a massive contradiction in big tech capital expenditures, or CapEx. Think of this like a really delicate seesaw. In scenario A, if big tech cuts CapEx, it's great for their own free cash flow, but it's absolutely terrible for the semiconductor stocks that rely on that spending. But in scenario B, if they maintain or increase that spending, semis boom, while big tech takes a hit to its bottom line. So what's the crazy part of our current market? Capital has recently been front-running a CapEx cut, propping up big tech while dragging down semis over the last 3 weeks. But here's the catch. Survey data shows over 60% of investors don't expect any CapEx cuts before late 2026.
To figure out how this seesaw actually tilts, we need to look at the AI monetization curve. Models are showing that 2026 will likely mark the bottom for free cash flow, purely due to these historically heavy AI infrastructure investments. From there, 2027 should show a gradual climb in returns, but the real significant surge in AI monetization won't arrive until 2028. Because that true payoff is so far out, the period from the second quarter to the fourth quarter of 2026 represents an incredibly critical and volatile window. That's exactly when this tug-of-war between big tech spending and semiconductor revenues is going to hit its absolute peak.
Technically speaking, semis are resting on a knife's edge right now. They perfectly tapped the first major support zone between 489 and 532 on Friday, hitting a low of exactly 498 before staging a bounce. Now, if they crack below this level, the next structural floor is way down between 450 and 467. And because there's massive overhead supply from heavy recent trading volumes, you really have to be careful. Treat any sudden upward moves strictly as temporary bounces for now, as the sector desperately needs time to recover its footing.
Section 4. Tech Earnings Previews.
These technicals make the upcoming big tech earnings the ultimate catalyst for the market's next directional move. Looking closely at the options market pricing, we can see exactly what traders are betting on. Google has an expected move of plus or minus $21 from a $350 base price. Tesla is sitting at a $370 base with a $25 expected move. And if you're tracking this, watch that 315 level closely as a hard stop loss. And then there's Texas Instruments, or TXN, which is pricing at a massive $31 swing from a $285 base.
Now, Texas Instruments is essentially a life-or-death sentiment indicator for the entire semiconductor space right now. $263 is the absolute line in the sand. If their earnings disappoint and the stock breaks below that $263 support level, there is virtually zero structural support beneath it. we could see a brutal 25 to 30% freefall, tumbling toward $238 or even $200, which would undoubtedly drag broader semiconductor sentiment down right along with it. On the flip side, clearing the upper expected move could be exactly the spark needed to reignite sector-wide momentum.
Section 5. ISRG Trade Execution. So how do you actually trade this environment? Let's look at a modeled execution strategy on Intuitive Surgical, ticker symbol ISRG. The mechanics detailed here are highly calculated. A 3% position was established at $354. This adds to an existing 1% bottom position held from $246.03. Because the immediate technical setup in the broader market remains vulnerable, the final 4% allocation is waiting patiently for a target buy zone between $246 and $313. Once that fills, it builds out a very solid 8% core holding.
The strategy here is pretty simple: diversification. If a portfolio is already top-heavy in AI and semiconductor names like Microsoft, NVIDIA, TSMC, and Google, ISRG acts as a highly effective hedge. Based on valuation models tracking decelerating growth rates across the market, a bottom for ISRG is modeled firmly between $292 and $300. By staggering the buys in tranches, the explicit goal is to lock in a total average cost strictly under $300, creating a substantial margin of safety.
Section 6. NASDAQ Technical Breakdown. Finally, looking at the NASDAQ, the structure is objectively cracking. Friday featured a nasty gap down to 686, intentionally slicing right through the critical support level of 693. To put it bluntly, the index has lost its structure and must rapidly reclaim 721, or we are in a definitive downtrend where any green days are just mechanical bounces. But here's the real danger detailed in the analysis. Extreme internal dispersion is distorting reality. Some stocks within the exact same sector are entirely collapsing, while others refuse to budge. The top-level index value is hiding a much deeper, systemic breakdown just waiting to trigger.